It looks like we have some interesting news from the Florida housing market in August, and I'd be happy to break it down for you in a way that's easy to understand. I'm Albert Stepniak, your friendly real estate agent here in South Florida. Essentially, the big takeaway from last month is that more people decided to commit to buying a home. The number of new pending sales, which is the industry's way of saying homes that went under contract, actually went up quite a bit compared to the same time last year. This is most likely because mortgage rates dropped a little bit early in the month. When rates go down, it makes housing a little more affordable, and that usually gets buyers moving. For single family homes specifically, the number of new contracts signed was up almost 10% from last August. That's a significant jump, and it's the largest we've seen since last November. When you look at condos and townhouses, those contracts were up about 5%. This is a pretty notable change, and it's the first time in quite a while that we've seen positive year-over-year growth for condos and townhouses. Since rates have actually continued to decline into September, it'll be fascinating to see if even more people decided to sign contracts this month. Now, while new contracts were up, the closed sales were actually down slightly in August. We saw about a 4% decrease in closed sales for single-family homes and a 6% drop for condos and townhouses compared to last year. Closed sales usually happen a month or two after the initial contract is signed. So because we saw a surge in new contracts in August, we might actually see closed sales start to pick up over the next couple of months. When it comes to prices, they were mostly holding steady or dipping just a little bit. The statewide median sale price for an existing single-family home was $410,000, which is just a tiny fraction lower than a year ago. For condos and townhouses, the median price was $290,000, which is a little larger decrease from last August. Remember, the median is the midpoint. So half of the homes sold for more and half sold for less than that number. In terms of supply, we're seeing a roughly 5-month supply of single-family homes on the market and about a 9-month supply for condos and townhouses. Generally, a 6-month supply is considered a balanced market. So while new contracts were the big story, we are still seeing some mild price declines and fewer new homes being listed than last year. The overall market is constantly shifting, especially here in Florida. So with so many people moving here, and that's why working with a local real estate professional is so important. We can help you navigate all these unique challenges, whether you're buying or selling, to make sure your interests are protected at every step. Now let's talk about what's happening with the housing market across the entire country, specifically looking at the numbers from August. Think of this like a quick check-in on how many homes are actually selling in the United States, which we call existing home sales. Overall, things were really flat in August compared to July, almost exactly the same. But technically, sales slipped just a tiny bit by 0.2%. Even though fewer homes sold, prices still went up. The typical or median sales price hit a pretty high mark at $422,600, which is a 2% jump from the year before. Homes are also taking a bit longer to find a buyer. The median time a house sat on the market nationwide was 31 days. It's no secret that the housing market's been moving slowly for a few years. Why? Well, two main reasons. Mortgage rates have been high, and there's just hasn't been enough inventory, meaning not enough houses for sale. The good news is we are starting to see a glimmer of hope. Experts are noticing that mortgage rates are beginning to decline, and more homes are finally coming onto the market. This should give a little push to sales in the next few months. Now, Let's look at the different regions because things are kind of mixed. The Midwest and the West actually saw a little jump in prices from July to August, but the Northeast and the South saw a dip. Looking at the whole year, the Midwest has been the star performer, mainly because homes there are relatively more affordable. The median price in the Midwest is about 22% lower than that national number we talked about. This affordability is a big deal, especially for first-time buyers. Breaking down the numbers a bit more, sales of single-family homes, the kind most people think of, dropped slightly in August, but sales of condos and co-ops stayed exactly the same as in July. Now back to inventory. We actually had about 1.53 million homes available in August. While that's a small drop from July, it's a nice 11.7% increase from a year ago. That's a positive step toward balancing things out. At the current pace, we have about 4.6 months supply of homes, meaning if no new homes came on the market, it would take almost 5 months to sell everything that's listed right now. Who's actually buying? About 28% of sales went to first-time buyers, which is a little more than last year. We also saw that 28% of all transactions were all cash. Cash sales is a big number. That means nearly 3 out of every 10 sales didn't involve a mortgage, which is actually a sign that investors or people with a lot of existing wealth are in the market. Speaking of investors, individual investors and second home buyers made up about 21% of the market, also a small increase. Overall, the market is steady, prices are up, and we're looking forward to more inventory to hopefully get sales moving faster. So there's been a little bit of news about what's happening with mortgage rates lately, and I wanted to break it down for you in a way that's easy to understand. Basically, after about a month of going down, the average rates for home loans have just started to creep back up this week. For the standard 30-year fixed rate mortgage, the average went from 6.26% last week to 6.3% now. It's a small increase, but it ends that nice streak of declines we had. Just for comparison, this time last year, that average was a bit lower at 6.08%. We also saw similar movement for the 15-year fixed-rate mortgage. These are pretty popular for people who are refinancing their existing loans. That average rate moved up from 5.41% last week to 5.49% now. A year ago, it was around 5.16%. These changes are always important because lower borrowing costs can really make a difference for people looking to buy a house. And that recent downward trend had been a good sign for potential home buyers who have been waiting for costs to ease up. Now, you might be wondering what actually makes these rates move up or down. A few big factors come into play. A key one is what the Federal Reserve decides to do with its own interest rates. Plus, you have investors in the bond market making bets on where the economy and inflation are headed. Generally, mortgage rates tend to follow the lead of the 10-year Treasury yield, which lenders use as a baseline for pricing home loans. Looking ahead, there is some positive news on the horizon. A major group called Fannie Mae, which tracks the housing market, is predicting that mortgage rates will actually start dropping below 6% by the end of 2026. Specifically, they project the average rate to land around 6.4% late this year and then fall to about 5.9% by the end of 2026. This is all tied to their expectation that we're going to see more people buying homes over the next couple of years. Nobody has a crystal ball, and if these predictions hold true, the total amount of money loaned out for mortgages is also expected to increase significantly, especially with more homeowners likely to refinance their loans as those rates come down. So while rates are up slightly right now, the long-term forecast suggests things should be better for buyers and current homeowners. So you might have heard the news that consumer sentiment, which is really just a fancy way of saying how optimistic people feel about the economy and their own financial future. That number dipped a little in September. The report from the University of Michigan said it dropped by about 5%. While it's a little less rosy than last month, keep in mind we're still better off than we were back in the spring. The dip in confidence seems to be something pretty much everyone felt across different ages and backgrounds. People with a lot of money tied up in the stock market weren't too worried, but folks with smaller investments or not at all felt less confident. The main reason for this overall slump is that people are still really frustrated with high prices. Almost half of the people surveyed said that inflation is eating away at their personal finances, and that's the highest this particular concern has been in a whole year. Basically, people are feeling squeezed by two main worries: that prices are going to keep going up and that the job market might start to weaken. It's a tough spot when you're worried about paying more and about your income stability. Now, on a slightly more positive note, people's short-term expectations for inflation, meaning what they think prices will do over the next year, actually eased up just a hair. They expect prices to rise by about 4.7%, which is down from 4.8% last month. However, the expectations for inflation over the long run, say 5 years from now, went up a second month in a row. Still, that long-term number is nowhere near the worst we saw back in April. All of this matters because when consumers feel good, they're more likely to spend money, which fuels the economy and in turn impacts things like the housing market. When they're feeling less certain, they tend to hold back, which can slow things down. Now, I wanted to chat about something interesting happening in the world of real estate investing, specifically for people who buy houses to fix up and quick sell, which we call flipping. Right now, if you're a home flipper, you're making less money than you used to. In fact, the typical profit margin before all the renovation costs and other expenses has fallen to 25.1% in the second quarter of this year. That's the lowest rate since 2008. When you look at the raw difference between what an investor paid for a house and what they sold it for, that gross profit dropped to about $65,300, which is down almost 14% from last year. Main reason for this drop is pretty simple. Houses cost a lot more to buy now. Flippers are competing for homes, and the prices they have to pay just to get the property are going up. This is especially true for those more affordable houses that might need some work, which are usually the ideal targets for flipping. The median price an investor paid for a flip house hit a record high of almost $260,000 this quarter. Meanwhile, the price they can sell the flipped home for, which was about $325,000, has stayed about the same since the beginning of the year. The overall housing market has been slow since mortgage rates started going up a few years ago. Fewer houses are selling and properties are sitting on the market longer, which actually gives people who can pay in cash, like many investors, a bit of an edge. Even with lower profit margins, a lot of flipping is still going on. Over 78,000 houses and condos were flipped from April through June, making up about 7.4% of all home sales. It's worth noting that investors are actually buying a bigger piece of the total market right now. About 1/3 of all homes sold in the second quarter were bought by investors, which is the highest share we've seen in at least 5 years. This includes both the flippers we're talking about and investors who buy homes to rent out. So while flipping is not as lucrative as it was a decade ago, back in 2012, the typical return was over 60%. Investors are still very active and buying up a significant portion of the homes available for sale. You know, the housing market is unbelievably tough right now. The cost of buying a home has climbed so high that the average age of a home buyer is now around 56 years old. That figure alone shows you how challenging it is for younger folks to get a foot in the door and start building equity. But I'm seeing a really interesting trend, especially with Gen Z. Since homes are so expensive, more and more young people are realizing they don't have to go it alone. They're actually teaming up with friends, not a romantic partner, but just their buddies to buy houses together. This strategy called co-buying is catching on fast. In fact, a good number of Americans have already purchased a home with a non-romantic partner, and a huge 70% of Gen Z folks are open to the idea. So, why are they doing this? Well, the main reason is simple: affordability. By pooling their money, friends can afford a bigger and better home much sooner than they could by themselves. Not only does this extra cash make it easier to actually qualify for a mortgage, but it also means the monthly payments are split up. For a lot of people, splitting a mortgage payment is actually cheaper than what they're paying just to rent. And hey, you also get to hang out with your friends more often, which is a nice bonus, as long as you actually like living with them, of course. Now, co-buying can be a smart move, but you definitely need to go into it with your eyes wide open. It does add some complexity. Most lenders and real estate agents are used to working with just two people, like a married couple. When you bring a bigger group, it requires a lot more coordination, and that can sometimes make people a little hesitant to help out. The biggest risk, though, comes down to shared debt. When you and your friends sign a mortgage together, you are all responsible for the entire loan. If one of your co-owners runs into financial trouble and can't pay their share, the bank is going to come after you and the other owners for that missing money. That's why real estate experts are stressing out one crucial thing. You must have a written cohabitation agreement in place before you sign anything. This is a legally binding contract and is absolutely vital for protecting everyone involved. This agreement should spell out all the details: how the house will be used, how all the finances will be split up, and most importantly, what happens if one person decides they want to leave. For example, what if they need to sell? Do the other have to buy them out? You need to have this contract in place first. If you don't, things can get really messy and contentious down the road. Co-buying is a great way to enter the market, but you have to treat it like the big financial commitment to it. It is. And not just a fun group project. Do you know anyone who has bought a home with a friend before? The Florida real estate market is rarely one size fits all. While we covered the big trends today, your situation, your goals, your timeline, your budget is completely unique. That's where the real strategy comes in. Don't try to guess what this market means for you specifically. Let's talk one-on-one. I've put a direct link to my calendar right in the description below, so you can schedule a private, no obligation strategy session with me today. Let's turn this market information into your success story. And if you found this video helpful, please hit the like button and subscribe. It helps me bring more valuable insights to the Florida community.